Hi there, this is Daniel from the Southwest Florida Real Estate Channel. I want to take a look for a minute at the plus minuses of owning real estate. In other words, buying a home. This is not really for investment, although I may blend some of that in there. This is about buying property and then moving in. The negatives, the positives and negatives. So what you've got is your basic positives here. You've got income taxes. So what happens with your income taxes is you get to claim deductions, okay? So if you're in the state of Florida, there's no state income taxes, so we're talking federal here. So what happens is the deductions you get to claim are for any interest that is paid. So what'll happen is when you pay interest on borrowed money, if you've got a mortgage, you'll get a notice right around February or March, preparing for an April 15th tax statement. And what it'll do is it'll tell you how much interest you've paid for the year, and whoever finishes your income taxes will be able to claim that as a deduction. In other words, what you do is you get to artificially lower the income that you made for the year, so thereby lowering the income taxes that you owe. And then points. What points are, what that means is when you borrow money, whether it's refinancing or financing the first time around in order to buy the real estate, you can pay points. Points are the other way to say it is like a buy down. What happens with points is, let's just say that your origination fee on your mortgage would have been 3%. But what you want to do is instead of paying 3%, what you want to do is you want to buy that interest rate down. You want to get it down into the 2s. Well, one way to do that is to pay points. So if you've got cash in the bank that's available, one thing that you can do is purchase the interest rate down. And so, for example, let's just say that you're borrowing $100,000 and you want to pay 1 point. When you pay 1 point, that 1 point is equal to 1% of the mortgage amount. So here that 1 point would be $1,000. You would be bringing that cash to the closing and using it to buy down this interest rate. How much you would buy it down, that's really negotiable. It depends on all kinds of things, the loan product, all kinds of stuff. But in general, what you're doing is buying it down by around 1/8. Right around 20% further down. So this would be, instead of 3%, maybe you'd be buying it down to 2.8. So that can make a difference for people. So show up with 4 points, and that would be, turn this into 4 points. You show up with $4,000 cash. What you're doing is front loading this. So the lender's still gonna get paid, but what you're doing is giving them some of the money you would otherwise pay them monthly and paying it up front. And so if you paid that, you'd be buying your interest rate down by quite a bit here. So anyway, so those points, when you pay those points, that's a good thing because it's just prepaid interest basically. So interest or prepaid interest, what you do is that lowers your income tax burden, and then origination fee as well. So if you pay a lender, a fee in order to find the right loan for you, that fee is a tax deductible thing. And then what you've got is depreciation. What I've done here, people kind of think that depreciation means something terrible has happened. Well, really that's not the case. Depreciation can be a real thing. In other words, depreciation can mean that you've got whatever deferred maintenance, which means maintenance you didn't do, so that could be a bad thing because your property's dilapidated, your improvement is dilapidated. But straight line depreciation is not necessarily a real thing. It's a tax thing. It's a paper thing. What happens is for a residential property, the reason they call it straight line depreciation is because it's in a straight line. It's the same amount. The straight line depreciation is the same amount every year for 27 and a half years, okay? So that's just federal tax code. And what happens is, what it ends up doing is if you just grab a calculator and you plug in 100, that 100 representing 100%, like a whole number, and then hit divide, and then hit 27.5, and then hit equals, what you'll do is you'll come up with the number 3.63636363 till the cats come home. And what that means is every year for 27 and a half years, you get to claim a 3.63% loss in value to your property. You don't get to do that to the land, but you do get to do it on the building, and that's great. Just think about the fact that people talk about property values going up and down. Over the history of this country, if you look at the value of a dollar, if you ever heard like Grandpa say something like, back in my day, a loaf of bread bread used to be a nickel. That's no joke. If you go back to 1776 and go all the way from there to today, and you take into account all the Great Depressions and all the recessions and all the bubbles and all the bursts and whatever, over the course of 40 years, a dollar becomes a nickel. That's called inflation. The reason that inflation occurs is because you've got something called the Treasury, and what the Treasury does is they've got a printing press. They get to print money. They also get to borrow money from places like China. And then, what happens is they take that money, they give it to banks. The banks generally are called the Federal Reserve. Okay, so the Federal Reserve, what that means, it's literally a quasi-governmental group of banks. That might sound creepy, but you've got 7 banks, like Citigroup and Wells Fargo, for example, U.S. Bank and whatever, Bank of America, and they've got heads of the Federal Reserve. And if you think of it like this, what you've got is the Treasury, and they come up with the money, they borrow or print it, and then what they do is they take that money and they give it to the members of the Federal Reserve, and those members of the Federal Reserve sell it to other banks, and those banks take that money and they sell it to us, okay? And so when they take that money and they sell it to us, what they're doing is they're doing it at what's called the prime rate. So they take it and sell it to banks at what's called the Fed rate or the overnight rate, and right now that's like 0.00 some odd, it's like free, 1% or something. And then they sell it to us at what's called the prime rate. What prime rate means is the primo rate, the best rate for the best consumers. So who are the best consumers? Been in the same job or at least the same business for the last 2 years. They've got 20% down payment. They've got a middle credit score. So there's 3 credit scores. There's 3 credit scoring companies: Experian, Equifax, TransUnion. And your middle credit score is the one they'll use. If you got a credit score in the 720, 700, 720s, and you got that down payment, and you've been in the same business, hopefully the same job for the last 2 years, you're a prime consumer. And so you get a prime rate. And that rate changes, fluctuates every day. It might be right now 30 years at 3.5%. And so, but that's what the process is here. The point being, though, so you got access to that money. You get that money, you use it to buy real estate. Over the course of 40 years, that's what I was saying, is that a dollar becomes a nickel. Well, what happens is that's inflation. People complain about things getting more expensive. The only reason that things getting more expensive would be a problem is if you don't own anything. If you got nothing that anybody else wants. Because inflation means that the boats that you've got for sale are more expensive, and the cars that you've got for sale are more expensive, and the real estate that you've got for sale is more expensive. That's inflation. So if you're working hourly and that is your financial plan, then yeah, inflation is going to beat the hell out of you. But if you, and I'm not trying to say you have to own real estate, but if you've got some stocks, bonds, real estate, whatever, you've got something available for sale and the cost of it goes up, that's your benefit. Well, what I'm saying is, partially because they keep printing money, partially because of other factors, over the course of 27 and a half years, your real estate is going to go up in value. Even accounting for the Great Recession and the Great Depression, over the course of 27 and a half years, real estate will go up in value on par across the country. And so what you get to do is you get to claim a loss in value while your actual value is going up, and in the middle right here is something called equity. Equity is the difference between value, we'll have to pretend that word says value, and debt. And by the way, most loans are 30 years, right? They're similar to that. So the idea being, over the course of 27 and a half years, you get to claim every single one of those years that the value has gone down, no matter what's actually happened to the value. So that's a pretty good gig right there. And then at the end of 30 years, your debts are gone, and whatever the value is, you can take it and sell it for that as well. So that's called straight line depreciation. So those are income tax things. I will send you over to the video about 1031 tax exchanges, because there's some other tax related stuff over there.